Welcome to ACCA Weaves. In this chapter, we will not memorize three disconnected formats. We will take one original trial balance, process its year-end adjustments, and make the performance, changes in equity, and financial position statements agree. Stay with the Aurora Kitchens example because, by the end, you will see how one adjustment travels through the complete answer. Every balance helps answer one of three questions. Performance asks whether the company made a profit and whether there was other comprehensive income. Position asks what the company controls, what it owes, and what remains for owners at the reporting date. Equity asks why the owner's interest changed during the year. These are different views of the same accounting records. A strong answer is not merely three tidy statements. The figures must connect. Here is our route. First, map each trial balance to its likely destination. Second, process adjustments such as closing inventory, depreciation, accruals, provisions, and tax. Third, prepare profit or loss and other comprehensive income, changes in equity and financial position. Finally, cross-check the links. Preparing statements comes after the workings. That order reduces repetition and makes errors easier to find. A complete set is broader than the three statements we are building today. It also includes cash flows and notes with accounting policy and explanatory information. Financial position reports assets, liabilities, and equity at a date. Profit or loss and other comprehensive income report performance over a period. Changes in equity explains movements in capital and reserves. Cash flows explain cash generated and used. Today, we deliberately focus on the first three. Cash flows and detailed notes deserve separate lessons. This flow is the spine of the chapter. Profit is calculated in the performance statement and moves into retained earnings. Other comprehensive income items move into the relevant reserve, such as a revaluation surplus. The closing balances of share capital and reserves are then reported as equity in the statement of financial position. If you understand these links, the final cross-check feels logical rather than mechanical. Aurora Kitchens is our original case for the year ended the 31st of December 2026, with figures in thousands of dollars. Related balances are grouped to keep the first view readable. Opening inventory of 180 plus purchases of 1,150 gives 1,330. Add operating expenses 380, property, plant, and equipment 1,300. Receivables and cash 702, and interest paid plus dividends paid 64. Debits total 3,776. Credits also total 3,776. Revenue 2,400. Opening equity 690. Accumulated depreciation 280. And loan plus payables 406. Equality tells us the unadjusted data is complete. It does not mean the year-end answer is ready. Use this 5-stage routine. Map balances, process every adjustment, build focus workings, prepare the statements, and cross-check the links. Starting with the final statement often causes duplicated figures, missing adjustments, and unclear workings. Calculate each adjustment once, label the result, and transfer the final number once. This gives the marker a clear route through your answer and gives you a route back if something fails. Aurora's inventory includes damaged goods, so we need a net realizable value check. Buildings and equipment require depreciation. Land increases in value by 100, introducing other comprehensive income and a revaluation reserve. Loan interest is 12%, but only part has been paid. A warranty estimate creates an expense and provision. Current tax is estimated at 75. For every item ask, what is a performance effect and what is a closing balance effect? That two-sided habit prevents incomplete adjustments. Within 12 months, is incomplete. An asset can be current because it is realized, sold, or consumed in the normal operating cycle, held for trading, expected to be realized within 12 months, or is unrestricted cash or cash equivalent. A liability can be current because it is settled in the operating cycle, held for trading, due within 12 months, or because the entity lacks a right at the reporting date to defer settlement for at least 12 months. If no relevant current criterion applies, classify it as non-current. Inventory costs $230. Damaged goods cost $20 but recover only $12. So the write-down is $8 and closing inventory becomes $222. Cost of sales is opening inventory $180, plus purchases $1,150, less closing inventory $222, plus depreciation $78. The result is 1,186. Check it. 180 plus 1,150 is 1,330. Minus 222 gives 1,108. Plus 78 gives 1,186. The write-down lowers a current asset and increases the expense within cost of sales. Land starts at 300 and rises by 100 to 400. Buildings cost 600, less opening accumulated depreciation 120 and current depreciation 30, closing at 450. Equipment costs 400, less accumulated depreciation 160 and current depreciation 48, closing at 192. Total property plant equipment is 400 plus 450 plus 192, or 1,042. The 78 depreciation charge reduces profit. The 100 land gain is other comprehensive income and builds the revaluation surplus. Keeping those effects separate is essential. The loan is $250 at 12%, so the full finance cost is $30. Aurora paid $24, leaving a $6 accrual. The warranty best estimate is $28. In this case, it is an administrative expense and current provision. Current tax is $75, producing tax expense and a payable. Payment does not decide whether an expense belongs in the year. Recognition and measurement come first. Cash paid helps calculate the remaining balance. IFRS 18 classifies income and expenses into operating, investing, financing, income taxes, and discontinued operations. Operating is a default category and normally contains main business activities. Investing covers returns from qualifying investments. Financing captures specified income and expenses from financing. Tax and qualifying discontinued operations have their own categories. Two key subtotals are operating profit and profit before financing and income taxes. Aurora has no investing income or discontinued operation, so its statement remains simple. Revenue is $2,400. Deduct cost of sales $1,186 to obtain gross profit $1,214. Administrative expenses are $248, the original $220 plus warranty $28, and distribution expenses are $160. Operating profit is $806. With no investing items, profit before financing and income taxes is also $806. Deduct finance costs $30 to get $776 before tax. Deduct tax $75, giving profit of $701. Add the land revaluation gain of $100 in OCI total comprehensive income is $801. Every subtotal comes from the lines above. No number is plugged. Defining profit as realized and other comprehensive income as unrealized is technically unreliable. Profit or loss contains income and expenses included in calculating profit. Other comprehensive income contains specified items that a standard requires or permits outside profit or loss. Estimates and some fair value changes can enter profit. Aurora's 100 revaluation gain is other comprehensive income because the applicable treatment places it there, not simply because no cash was received. Aurora opens with share capital $400, share premium $80, and retained earnings $210, total $690. Profit of $701 increases retained earnings. The 100 land gain increases the revaluation surplus, not retained earnings. Dividends paid of $40 reduce retained earnings because they are owner distributions, not expenses. Closing retained earnings are $210 plus $701 minus $40, or $871. Total closing equity is $400 plus $80 plus $100 plus $871, or $1,451. This total transfers unchanged to the statement of financial position. Financial position is a snapshot at the reporting date. Assets are the resources. Equity and liabilities explain how those resources are financed. The equation is assets equals equity plus liabilities. But a balance statement can still be wrong. A 5-year loan placed within current liabilities may leave the equation balanced while the classification remains incorrect. Property, plant, and equipment is 1,042. Current assets are inventory 222, receivables 310, and cash 392, giving 924. Total assets are 1,966. Equity is share capital 400, share premium 80, revaluation surplus 100, and retained earnings 871, giving 1,451. The loan 250 is non-current. Current liabilities are trade and other payables 190, including the original payables, interest accrual and warranty provision, and current tax 75, total 265. Add 1,451, 250 and 265. Financing is 1,966. The statement balances without a false figure. Check 1. 210 opening retained earnings plus 701 profit minus 40 dividends equals 871. Check 2. 0 opening revaluation surplus plus other comprehensive income of 100 equals 100. Check 3. Assets 1,966 equal equity 1,451 plus liabilities 515. If one check fails, do not insert a balancing figure. Return to the related working. A retained earnings failure points toward profit, dividends, or opening equity. An equation failure points toward an omitted or duplicated balance. Pause and classify each item. For closing inventory 222, decide the asset and cost of sales effects. For land revaluation 100, decide whether it belongs in profit or other comprehensive income and which reserve changes. For unpaid interest 6, identify expense and liability. For profit 701, identify where it moves within equity. Finally, consider a dividend declared after the reporting date. Does it create a liability at that date? Write statement of profit or loss, other comprehensive income, statement of changes in equity, statement of financial position, or no adjustment beside each item. Pause the video now and attempt all 5. Inventory 222 is a current asset and reduces cost of sales. The 100 revaluation gain enters other comprehensive income, increases the revaluation surplus, and increases property, plant, and equipment. Unpaid interest 6 is a current liability, while total finance cost remains 30. Profit 701 increases retained earnings through statement of changes in equity. Do not add total comprehensive income to retained earnings because other comprehensive income belongs in a separate reserve. A dividend declared after year-end creates no liability at the reporting date in this fact pattern. Stating both sides of an adjustment makes your reasoning visible. Read the requirement. Are full statements, extracts, or explanations needed? Set up recognizable performers. Show separate working for inventory, property, plant, and equipment, tax, finance costs, and reserves. Transfer each final figure once. Then reconcile equity and balance the statement of financial position. Clear professional presentation does not replace correct accounting, but it makes correct accounting visible and supports method marks. Why does closing inventory affect profit and assets? It is a current asset and is deducted in cost of sales. Why does revaluation change total comprehensive income but not profit? The applicable standard presents it in other comprehensive income and the revaluation surplus. Which closing equity figure from the statement of changes in equity must agree with the statement of financial position? Every closing equity component should agree, and total closing equity must equal the equity section in the statement of financial position. If you can explain these links without the formats, you understand the structure rather than merely memorizing it. The core preparation process is complete. Adjust first, build controlled workings, present the linked statements, and cross-check the transfers. Profit and other comprehensive income explain equity movements. Closing equity enters financial position. Your next lesson is tangible non-current assets, where we deepen cost, depreciation, and revaluation. The idea behind Aurora's 78 depreciation, 100 other comprehensive income gain, and 1,042 closing property, plant, and equipment. The following slides are optional extensions. The final slide will bring everything together. Keep this distinction simple for now. Fair value movements on qualifying fair value through other comprehensive income debt instruments may later be reclassified to profit or loss when IFRS 9 requires. Revaluation surplus is not recycled to profit or loss. Movements on an equity instrument designated at fair value through other comprehensive income are also not recycled. Do not learn the full instrument mechanics here. The point is that other comprehensive income is not one uniform bucket. The applicable standard determines later reclassification. IFRS-style titles are clear in an exam, but familiar alternatives such as balance sheet or income statement may be used when their meaning is unambiguous. Do not spend time worrying about one compulsory label. Focus on required content and consistent terminology. If the requirement uses a particular title, following it is usually the cleanest approach. Not-for-profit and public sector entities still need reliable information about assets, liabilities, income, costs, and cash. The decision focus changes. A profit-oriented entity emphasizes profitability and shareholder returns. A not-for-profit or public sector organization may emphasize service delivery, value for money, accountability for grants or public funding, and economy, efficiency, and effectiveness. This is mainly an interpretation topic in FR, so it belongs in a separate lesson rather than inside Aurora's preparation flow. Aggregation combines items sharing characteristics when one line gives a useful summary. For example, similar trade payables. Disaggregation separates items when different characteristics or material information would otherwise be obscured. Separation may be on the face of a statement or in the notes. The goal is neither the fewest lines nor maximum detail. It is a useful structured summary that does not hide material differences. An entity may present one statement of profit or loss and other comprehensive income, moving from profit through other comprehensive income to total comprehensive income. Alternatively, it may present profit or loss and a second statement presenting comprehensive income, beginning with profit and adding other comprehensive income. Presentation changes, but the economics and final total do not. Follow the requested format. If none is specified, use a clear, recognizable answer consistently. We began with one trial balance. You can now process the year-end adjustments, prepare 3 connected financial statements, and prove that the final figures agree. Remember the 4-step method. Adjust first, follow the flow, use a clear IFRS 18 structure, and always cross-check. For Aurora, profit is 701, closing equity is 1,451, and total assets equal total financing at 1,966. Before moving on, attempt one-time single-entity question and label every working before transferring your figures. But Aurora still leaves us with an important question. How did the land increase from 300 to 400? Why did the gain bypass profit? And what happens to depreciation after an asset is revalued? That is exactly where Chapter 2 begins. Tangible non-current assets, cost, depreciation, and revaluation. I'll see you in the next chapter.